So, ladies and gentlemen, dear colleagues and dear panelists, my name is Frank Schweitzer. I'm a professor of systems design at ETH Zurich, and my research is focused on economic networks and social organizations. My chair is part of the Department of Management, Technology and Economics of ETH Zurich. I'm also a founding member of the ETH Risk Center, and I am, together with Ernst Fehr from the University of Zurich and Didier Sonnet from ETH Zurich, the main organizer of this largest symposium, Economics on the Move, Trend and Challenges from the Natural Sciences. Day 2 of our symposium is devoted to the problem of systemic risk, one of the really hot topics overarching different scientific disciplines, not just economics and finance. And today's panel shall allow us to deepen our discussion about this topic by asking the provocative question, systemic risks, are there lessons to be learned? Before I hand over to our panelists, let me give a very short motivation for the topic. So what is systemic risk? It is a risk that a system comprised of many interacting economic or financial actors or agents in general collapses or fails to a larger extent. This loose definition does not explain why the system fails. And everyone in this panel has its own view about the reasons. So let me start by putting my 3 cents on the table here, and everyone else has a chance to give his 3 cents afterwards. I will do this with 3 negative sentences, what I think systemic risk is not. So, first one, systemic risk does not depend on extreme exogenous events. If these happen, they may start a failure cascade, but we have demonstrated that systems are able to resist even extreme shocks, provided that there is the right interaction between agents and the right ability of adaptation. On the other hand, we could also show that even very small shocks are able to trigger a full cascade if there are flaws in the architecture of the network. The second remark, systemic risk is not focused on systemically important institutions or agents. A careful network analysis, as we have done this in my chair, verifies that almost all systems, and we are talking about economics and financial system in the first place, these systems have a small but strongly connected core of major institutions that are densely connected. There is not the one systemically important institution. There are maybe a few hundreds, a few thousand institutions that form a densely connected core and cannot be separated. The third remark, systemic risk is not confined within a specific system. That means only within a financial or a technical system. It spreads across systems that are of various types but interconnected. As a result, for example, a tsunami close to the east coast of Japan is able to shut down all power plants in Germany with a certain time lapse. This is what we have to understand. And there is an amplification and a feedback on a social level that we need to incorporate in our theories of systemic risk. Let us now see what are the lessons to be learned from the viewpoint of our different panelists, which I want to introduce now in alphabetic order. I start with Jörg Blum. He's the head of the unit Systemically Important Banks at the Swiss National Bank. He has a doctoral degree in economics and has published research in the area of banking regulation, especially on capital adequacy requirements. He's closely involved in the ongoing work to address the too big to fail problem in the Swiss banking sector. Second panelist, Rama Kant, is a professor in the Laboratory of Probability and Risk Modeling at the University of Paris 6, and he's also the chair of the SIAM activity group on financial mathematics and engineering. Former positions of Rama Kant include professorships at Columbia University, New York, and École Polytechnique in Paris. And I'm also very happy to say that very soon, namely from the 1st of October, Rama Kant will be a professor of financial analysis at Imperial College London. Our third panelist also gave a talk this morning. Carsten Dakin obtained his PhD in economics from the University of St. Gallen for analyzing the necessity of fiscal constraints in the European Monetary Union. After working 3 years in what is now the UBS, he joined the European Monetary Institute in Frankfurt, and after 12 years in various functions at the European Central Bank, he now heads the Financial Stability Surveillance Division of the European Central Bank's Directorate General Financial Stability. This surveillance division, I should also add, has a leading role in producing the European Central Bank's financial stability reports and provides the European Central Bank analytical input to the European Systemic Risk Board. Peter Fischer, Neue Zürcher Zeitung Zürich, is the head of economics and business editing of Switzerland's main economic, political, and financial quality newspaper, NZZ. He leads a team of about 45 economic journalists worldwide. Peter Fischer has studied economics in Bern, Kiel, and in Scandinavia, and holds a PhD in international economics from the University in Hamburg. He did some empirical and theoretical work on mobility and spatial modeling before joining the NZZ in 1999. And he also worked as an economic correspondent in Russia and in China before returning to Zurich and joining the NZZ here in the main headquarters. Jean-Charles Rocher from the University of Zurich is a professor of banking and a senior chair at the Swiss Finance Institute since 2010. Before, he had academic positions in Paris, London, and Toulouse. His research is about banking crisis and regulation, and he is currently the president of the Econometric Society and associate editor of the Journal of Finance. Didier Sonnet is professor of entrepreneurial risk in the Department of Management, Technology and Economics at ETH Zurich. He's also a professor of finance at the Swiss Finance Institute. And in 2008, he launched the Financial Crisis Observatory at ETH Zurich to test the hypothesis that financial bubbles can be diagnosed in real time and their termination can be predicted probabilistically. Joe Stieglitz, who just gave the talk before the coffee break, is a university professor at Columbia University. He's the winner of the 2001 Nobel Memorial Prize in Economics. He also is a lead author of the 1995 IPCC report, which shared the 2007 Nobel Peace Prize. He was the chairman of the US Council of Economic Advisors under President Clinton and chief economist and senior vice president of the World Bank from 1997 to 2000. In 2011, the Time magazine named him one of the world's 100 most influential people. So let us welcome all these people. Well, I'm very grateful that you agreed to join this panel discussion, and we start in the following way. Every one of you has now the chance to give a very short statement, not longer than 3 minutes, about the lessons that you think has been learned or should be learned from your perspective. Then we have a discussion within the panel, and at some point in time, I will open the discussion also to the audience to ask all the questions that could not be asked until now. Yeah? Please, we start with Jörg Blum. Yeah. So. You have to switch it on. Or maybe it's on. Yeah.
Is it on? Okay. So, of course, there are many lessons to be learned from the crisis, and it also depends on who you ask. I, of course, have a banking regulation background, so I present to this distinguished audience 2 lessons I draw from the crisis. The first is that a system is not necessarily stable if all the components, the individual components, seem stable. As you know, before the crisis, most of the individual banks looked more or less stable, but it turned out that the whole system was quite fragile. One reason of this was that banking regulation has traditionally focused too much on the individual institutions and not taken systemic risk into account. So it was the idea if each bank is safe and sound, then the whole system is safe and sound. And I think we have learned that this is not necessarily the case. One possible solution to this problem is the so-called Macro-Prudential Approach, where the supervision and regulation also takes a systemic view, for instance, the banking system. The second lesson I would draw from the crisis, which may be relevant also for this circle here, is that there are limits to explain and control complex systems using complex models. I think it's fair to say that the highly sophisticated risk management of most international active banks have failed, and usually they have failed miserably. And in such an environment, it may be useful to have additional tools and instruments that are much simpler, much more crude. For instance, now in the international regulatory standards for capital requirements, we also have a so-called leverage ratio, which is totally insensitive to risk, but prescribes a minimum level of capital for banks, as with the purpose of having a kind of a backstop or a complement to the complicated risk-based capital requirements.
Okay, thank you very much. Rama?
Thank you very much. So first, let me start by saying I fully agree with the points raised by the first speaker. And one of the points he raised was that we need to move to a system-wide approach in the monitoring and the regulation of risk. And the first step you need, the first ingredient that you need for implementing such a system-wide approach is to have data. You need to map what the system looks like. And that implies having data on the links between financial institutions, interbank exposures, funding mechanisms, how the funds flow, where they flow. Is there a concentration of risk across the banking sector? And there's a lot of data going around inside the regulatory institutions on individual banks' portfolios, but there is no, at this stage, there is no systematic collection of data in a database which will enable to map out the structure of the system. So this is not done in the US nor in the EU at a system-wide level. So the second point I would like to raise is that what we have learned is that well-intentioned rules and risk management recipes, which apparently reduce risk for an investor or individual institution, may backfire and amplify systemic risk. This was very well pointed out in Professor Stiglitz's talk regarding diversification. He pointed out why diversification can be good for individual investors, but actually increase systemic risk. And there are other examples of this. For example, pro-cyclical capital requirements that are currently implemented in the banking system. We know that they amplified actually the consequences of the Lehman default, so capital requirements which were jacked up after the system was hit by a shock, forced banks to engage in fire sales on a massive scale, and this, as we know, amplified the systemic risk. So we need to carefully think about what may be the unintended consequences of rules or recommendations that we or regulators give to individual institutions. And the third point is that we have learned, if we didn't know this, or some people have learned, that somebody needs to be in charge of monitoring and regulating systemic risk. I mean, this may seem obvious to many here, but actually no institution was clearly given a mandate to manage or monitor systemic risk. And there still lots of things where nobody's in charge. So in Professor Stiglitz talk, he alluded to the rating agencies. Rating agencies are still essentially unregulated, and they play an important role as vectors of systemic risk. And also, we saw in the LIBOR scandal that very important indicators, benchmark rates, on which the trillions of dollars of products are indexed, they're subject to no control or regulation. They essentially fall out of the legal scope of all existing regulatory agencies. So what we've learned is that self-regulatory mechanisms didn't work and will not work. There is both theory and empirical evidence which points to that. So somebody needs to be given a clear mandate, and so the legal mandates are coming. The ECB was given this mandate, I think, yesterday, but it's not clear whether they have the tools or the means or even the framework conceptually to meet this challenge. So here are my 3 points.
Okay, thank you.
Thank you. Let me just repeat that again. These are my personal views and not those of my institution. 2 messages, hopefully, and I just heard they might be controversial. First one is there is, of course, consensus that the partial failure of the micro and macro supervisory process allowed the build of systemic risk in a run-up to the current crisis. My thesis here, which might be the controversial part of that, is that the new European supervisory architecture, as we're building it now, has the potential to correct these relevant deficiencies. So let me just mention what were these macro-prudential failures, of course. It's obvious, right? On the micro side, we had the misinterpretation of the securitization business, the allowance of off-balance sheet vehicles, which were actually not off-balance. We had the misperception of risk-weighted assets versus true leverage. We had implicit government guarantees whose incentive were not fully internalized. We have national political biases in the supervisory and regulatory system. And we had the general intransparency of balance sheet analysis due to lack of data harmonization, especially within Europe. So these were clearly failures. On the macro side, it was already mentioned, there was no macro-prudential supervisor around. What came closest probably were central banks, in case you had the notion that in order to preserve price stability in the long run, you might want to do something called leaning against the wind in the short run, fighting potential building imbalances. But that probably, there was a strong skepticism to this attitude. On the other side of the Atlantic, for sure, ECB a bit less because we had this monetary analysis focus, but that is changing also. That is also changing. So now what's going on with I told this morning about the European Systemic Risk Board setup. So there is somebody in charge of the macro-prudential analysis, risk warnings. The ECB will now get the powers also for invoking macro-prudential policy tools like countercyclical capital buffers. That's at least proposed in the new regulation. We'll see how far we get there. And as you just mentioned, also on the responsibility for the microprudential rules, so that this national biases in the supervision process should be credibly eliminated. And also there's for now the first time a chance really to harmonize transparency. Final point, or the second hypothesis, I didn't expect people to show up before 10:30 and the Nobel Prize was talking, so I repeat one of the theses I had. That actually the current progress we are doing leads into the direction that an early warning system is feasible, that early warning against systemic risk is actually feasible, based on the fact that there are regular patterns, contrary to what many people, which are relatively simple, like it was mentioned already several times, the reliance on credit booms. There's hardly any crisis without a serious credit boom bust cycle. And then, again, lessons learned. We know now that narrow spreads are not necessarily low risk, but they stand for risk which is mispriced. High return on equity doesn't stand necessarily for profitable business, but excessive leverage and excessive risk-taking. Loan-to-deposit ratio, same thing, must signify a funding vulnerability, not necessarily an efficient market-based system. So these are lessons learned.
Thank you.
I think.
Well, I understand that my role here is a little bit to bring a public view into this discussion. So I think after 5 years of financial and economic crisis, the public or I encounter often ask, actually, has economics failed? Have academics failed? Has capitalism failed? I don't think so, but I think that new questions have to be asked. And one question is whether now really the right lessons are learned in fighting this crisis, or whether maybe, for example, monetary policy could give rise to the next bubble and the next crisis, and if maybe the current trend towards more regulation really helps mitigate the risk of new crisis, or could actually be too much of it, rather. Then I think I'm an economist myself, so the question is, of course, for me, what should economics learn from this crisis? I think it has become clear that the lack of really representing the financial system in macro models is something that should be that needs a remedy. I also think that in general macroeconomics need a better micro foundation. I would put the hypothesis that a certain obsession with linear dynamic optimization has hampered further insights in economics. I'm pleased with behavioral economics because I think it provides us with a more realistic representation of how people act and decide. But however, to me at least, it's not quite clear how these insights can be incorporated in models or macro models in a way that it really helps us to capture systemic risk better. Finally, I think that new ways of modeling systems from mathematics and physics, they could, of course, help us to provide a new approach towards understanding systemic risks. However, I'm also a little bit skeptical because I think that part of the shortcomings in the development of academic economics has illustrated that there is always a danger that people or academics from natural science, mathematicians, other professionals come into economics primarily because they search for new applications for the fancy models. But then actually there is a certain lack how their insights could really provide prediction capacity that would make them valuable and applicable for economic policy making. I think I'll leave it with that.
Yeah, okay.
Thank you very much. So good morning, ladies and gentlemen. It's a privilege for me to participate in this panel. Yes, there are important lessons to be drawn from the financial crisis, not necessarily the ones that the majority of commentators put forward. I do not think that economic theory in general should be put in accusation. The economics that was taught a long time ago contains all the tools that are necessary to understand the mechanisms of a systemic crisis and to give policy recommendations to reduce the probability and extent of future crises. But the economics I was taught insists on market failures that can be due to externalities, non-competitive behaviors by large companies, more hazard, asymmetric information, and the like. And who better than Joe Stiglitz here, who was probably the most brilliant contributor to this literature, can testify of the importance of this branch of economics. Now, why is it that the dominating paradigms for about 20 years, both in micro and macroeconomics, were essentially rational expectations and efficient market hypotheses? Well, it could be because of the fascination for mathematics and physics, but I have another more pragmatic interpretation, which is that it was in the interest of the very powerful business lobbies who not only influence public decisions making, but also, and I'm ashamed of that, also had an influence on a fraction of the economics profession who defended views favorable to the business community, especially in the US. So yes, I'm ashamed that a large number of my fellow academic economists felt obliged to develop models that neglected frictions and market failures. If you want to publish in the influential finance journal or get a job in the finance department of a top business school, which is very well paid, you had to, and maybe you still have to, defend business positions. But I don't want to focus on the specificities of the academic world, which is a very small world and often very remote from the real world. The problem is that the influence of lobbies is more serious than just putting in doubt the integrity of some academic researchers. This is why I will confess a big mistake that I and other fellow economists have to acknowledge. I was talking before of the second best economics, that the work of Joe and his colleagues, the part of economic theory that I like. But I was very naive in thinking that market failures could be corrected by benevolent regulators. The idea was that public authorities would set up strong and independent regulators who would, with the help of independent, unbiased experts, supervise the financial industry and curb the excessive behavior of excessive risk-taking of bankers. The financial crisis has shown that this doesn't work. Supervisors, regulators, and even some governments, and let me be clear, I don't have Switzerland in mind, because Switzerland is one of the few exceptions where there was real independence of political authorities and they managed to have the courage to curb the excessive risk-taking by the large banks. But I'm talking of other countries. You may guess which countries I have in mind. And I believe that we need to do something about that. So there is a big hole, a big missing tool, or at least underdeveloped tool in economics, which is the political economy of bias regulation. What do you do when you have to curb the behavior of markets? Because, you know, competition is the #1 force. But we know that competition has its failures. And we hoped that the government would be able to correct this failure. And this hope is now forgotten. So we have to do something else. We have to invent new tools to protect democracy and, you know, freedom of markets or competition. But both are needed, but one without the other doesn't work. So I think the Fukushima catastrophe is also a good illustration of the collusion between the experts and the industry. So Frank Schweitzer asked me to say something about what other sciences can bring to economics in the study of systemic risk. I am very much interested in development that come from physics, for example. I think it's a very interesting and very promising direction. I also think that behavioral economics is something very important that we borrow from psychologists. But I believe there is a first-order thing to be solved, a third-order problem, which is that the current political system, what we call democracy, is too much influenced by the lobbies and is not able to curb the excesses of the market. So I believe we have that #1 issue, and maybe we have to borrow from political science, which was probably not a science that you had in mind in your question.
But it was also mentioned by other speakers today, like Mr. Detke. Yeah.
Okay, can you hear me? Yes. Good morning, ladies and gentlemen. So I would like to start with a different pitch. I would say what we have not learned from the crisis. We have not learned that financial crises are exceptional, but rather that they are the norm in any market economy as soon as there is debt and credit. We have been reminded of this, but we have forgotten. We have not learned this. We have not learned that there is a loss of fiduciary principle, growth of moral hazard problems, conflict of interest at the basis, and rampant behavior at the basis of crisis, and so on. We just have to look at 5,000 years of debt history in the world. We have been reminded of them. We have not learned. We have not really learned that cascade effects occur in complex interconnected systems. This is something, as we have heard before this morning in many other instances, that are permeating all systems of all kinds, of course, including economic and financial systems. So I'm a bit shocked when somehow we are coming back to this problem, because this is just a reminder. We have not learned this. If we take this stance that we have learned this, we are just the butterflies coming to the lamp again and again, forgetting the past. So I would like to suggest that we have learned something much more fundamental. I think that we are learning with this crisis, which started in, let's say, in the US and then is cascading and ongoing with the major problems not addressed, even with the recent development in Europe, is that we are crossing over to a new era. There's a fundamental regime shift that we are living. It's a historical moment. By historical moment, I mean something that can develop over decades. And I want just to give you an impression of the type of insight that you're going to have. So we are not allowed to show graphs in this, but I can show you a little bit of impression of 400 years of data showing inflation in 4 of the major powers in the earth. This is data collected by Sagan, a famous economist also. And when you see that only during First World War and then emerging much more drastic with the Second World War and then exploding in the last 50, 60 years, prices were stable, but they have been exploding since then. So we are in a new era that, of course, most of us are taking as the paradigm, as the norm, but it was not the norm for a very, very, very long time. Depth also. We take the depth growth as something which is absolutely normal. And I'm absolutely shocked when I see this data put together by McKinsey, which shows the fraction of depth to disposable outcome of household in the US, which is taken as a norm to grow. So, and you see the graph here showing that, yes, we are going back to normal. And what is the norm? The norm is actually to grow the depths. And they say this regression, while they forget there were 20 years where the level was about 60%, which is, by the way, the Maastricht reference treaty. So to me, it's shocking to say that we are going back to normal when the norm is supposed to be more and more indebtedness in a relative fraction to disposable outcome. So there are many, many other, let's say, facts or things that you can look at in terms of evidence of relatively recent on historical proportion problems. So I believe that we are seeing the first travail, we say, like giving birth to a new era where the old solution and even the historical lesson of the recent past, by recent past I'm just meaning four decades, will not help us to solve the problem of the future. And I'm very much afraid that many of the discussion that we have heard may be fighting the last war rather than really looking at the very big challenging problem. To finish, I would say, and I will develop that maybe in the discussion later on, I think that the bigger question that we may learn from this crisis is to look ahead and to think about the bigger systemic crises that are coming with the even more stronger interconnection between not only within finance and economics, but with global climate change, environmental stress, agro-business strategy, big pharma and health, and basically the pursuit of happiness, which is, by the way, one of the fundamental constituents of the US Constitution. What do we call happiness at the founding structure to think about new development in the future? So this is, for me, the main lesson of think of the future in terms of prediction of future development of a new era.
Okay, Joe.
Okay, thank you. I was pleased to find that the reason we're in this order is alphabetical, and not that I was on the far left.
Okay.
I like to think of myself as very centrist. So, I want to pick up on a couple points that have already been raised. The first one is the point that was made in the very beginning, that dynamic instability doesn't necessarily come from very big events. If you have a poorly designed system, even a small perturbation from an equilibrium, from an unstable equilibrium, can lead to systemic instability. And I think Europe is a good example of that. The European financial system, for instance, each country's banks are implicitly supported by the government of the country. I mean, all banks, and we saw that very clearly in the 2008 crisis. It was the ability of governments to bail out banks that gives people confidence to put their money in the bank. Well, that system is inherently unstable, and if you perturb it just a little bit, it can start unraveling. So what has happened is, as a particular country, we know which countries we're talking about, their government gets weaker, the backing, the implicit subsidy from the government guarantee to that banking system goes down. That means that people will leave that country's banking system, or the interest rate it will have to pay will go up, but in either case it becomes less competitive. And then money moves out. As money moves out of that banking system, the economy gets weaker. As the economy gets weaker, the ability of the government to support that country's banking system diminishes, and the system unravels. So that's an example where what began with a lack of a basic principle of a single market, the notion that free mobility of finance across Europe, principles that seemed to make sense, they didn't get the details right, and they created a system that was dynamically unstable and predictably would unravel once you have a little perturbation from the center. It doesn't take a black swan event, even a small one could have led to this. And there are lots of other examples of that within the Euro design. The debate, as I see it as an outsider, about the European framework has not really focused on the structural aspects of the European design. The second general point I wanted to make is that there's a nature, fundamental nature of markets to go to a point of fragility. And by that I mean the following. If you lowered the risk in an economy, the natural tendency of firms would increase their debt-equity ratio, because they will feel that with that higher debt-equity ratio, the probability of default will go down, is lower. But once they increase their debt-equity ratio enough, the probability of bankruptcy goes back up. So that there is a self-reinforcing mechanism in the market that may lead inherently to fragility, so that as we make the system more stable, markets will respond in ways to undo that effect. The third, and I think it was very telling in the first presentation about this, is the failure of our price system. And there's a huge literature, and I would say more generally, of market failures, but I want to talk about two aspects of these market failures. Huge literature talking about the importance of the price discovery mechanism. And that, in the United States, has resulted in some of the greatest absurdities. I don't know if people here have been following it, but over 60% of all trades in the stock market today are between computers in nanoseconds. They're not about the discovery of real facts, real information. It's about extracting information from other computers and trying to outsmart other computers. So we've created a stock market that is, to a very large extent, devoid, de-linked with the real world. But that very fast system has this characteristic. Not only isn't doing price discovery, has a lot of fragility, as we saw on the May 6th event, when, according to that market, if you took those market numbers, several $1 trillion were wiped out in 20 minutes. Now, if anybody, that's as much as gets lost in a war lasting 5 years. We did that in 20 minutes. Then it got recreated in another few hours. But there's another aspect of this that was emphasized when we talked this morning. This price system not only fails in general, but it fails very often in pricing risk. And if you fail to price risk, that means some of the time when you're underpricing risk, if you just think of it, sometimes you overprice and sometimes you underprice. But if, when you underprice it, people wind up taking more risk, there is a tendency in the system to, again, fragility. And that, I think, is one of the things that's happened more recently. As we put more reliance on prices rather than on quantity constraints, like we used to, we didn't have this faith in prices, and this faith in prices, I think, has been very destructive of the functioning of the market. One example of a fake faith in prices was the LIBOR that I mentioned before. There's a $300 to $350 trillion market in derivatives based on a number that we know is totally phony and manipulable. And not only manipulable, manipulated. We don't know what that number is. We know that that number is not real. It's supposed to be the number at which banks lend to each other. But we know they don't lend to each other. Then it's supposed to be the number that they could lend to each other. But we know it's not that. Or if it is that, that number has nothing to do with measures of CDSs or bond prices. And so the interest rate is de-linked from any other price in the market. So we have created a $350 trillion market that is totally phony. But it's a multi-year market that we don't know how to take down, that we can't restructure. So this is an example of how we create structures that are so flawed but permanent that destructuring them is not easy. So much for the rationality of the market. Now, the final point really was, I was going to talk about, was going to pick up on what Jean-Claude, Jean-Claude said.
Jean-Charles.
Which I think is really important about the political economy. And I was going to focus on one aspect of that, about the difficulty of trusting central banks. And obviously, I think after the crisis, very few of us really have that much confidence in central banks. But I want to give you just another example that you were saying, you know, what have we learned from the crisis, you know, in the aftermath? Take a more recent event. There was a question about the restructuring of the Greek debts. The question arose, should everybody agree that there needed to be a very major restructuring of the Greek debt? No way that we could go on without that deep restructuring. Then the question was, should it be a voluntary or involuntary restructuring? Well, the ECB said it should be a voluntary restructuring. Why was that important? That was important because if it were an involuntary, it would trigger these very complicated CDSs. But then things became very mysterious. Because if the ECB were a good regulator, it would have wanted the banks who held the Greek bonds to have bought insurance against the risk that their bonds would be restructured and they lose 50% of their value. But if you bought insurance, what is the thing you really want? You want the insurance to pay off. You don't want to buy insurance, and then when the fire comes, they say, sorry, your insurance doesn't pay. But the ECB said, we're very happy that you bought insurance, but we're going to try to make sure that your insurance policy doesn't pay. And the ECB is supposed to be the organization is protecting the banks and the banking system. And it says, we're glad that you bought insurance, but by the way, we are trying to arrange it so you will take a loss and your insurance policy doesn't pay. Well, there is one explanation for this. There were banks, some people think Goldman Sachs, that were not buying insurance, but were gambling. And so one hypothesis is that the ECB was taking the position of protecting the gamblers. Well, I don't want to get into that, what was really motivating them. But you can all have your own speculations. But what was clear is they weren't doing what they should have been doing to protect the banks who had acted responsibly and bought insurance. Now, what they said sometimes was, and this goes to the point, we were afraid that if there is a credit event, it will destabilize the market. Well, you said, as the regulator of the financial system, you should have constructed a financial system with regulation so that the failure of a Greek bank, of Greek bonds, of write-down doesn't disturb the system. We all know about Lehman Brothers. Now, you've learned something, haven't you? You know, you have the data about the interconnection, don't you?
Too late.
But this was years after, this was 2 years later. And they said, we don't know, or at least that was one of the claims. So that's the other claim relative to the one is protecting Goldman Sachs, the other hypothesis that they didn't know. What happened in the end? They did declare a credit event, and nothing happened. So what is clear in the end, their judgment about their fears was not realized, but that is consistent with the way the banks have consistently behaved, using fear as a slug, as a cudgel to get what they want. Well, all of this says that clearly the central bankers are not the people that we can trust to deal with the problem.
Yeah.
But that raises the very, very deep issue. How do we construct a political economy? Because it has to, there's market failure. I think that there are institutional frameworks that can work. There are some countries that are doing it, but I think that ought to be the center of a lot of our discussion. How do we create political systems where we can protect ourselves against that aspect of systemic risk?
Okay. Let's thank all the panelists for the initial statements. We move now from the monologues to the dialogues, and for a little bit of discussion, let me try to structure all the different viewpoints along a few lines. So the first one I would like to pick up because it basically constructs a little tension between what the banking representative said and the rest of the panel. So there is this big optimism about the macro-prudential regulation that's coming up on one end. So both of you emphasize this, and there are new hopes of structuring the system. On the other hand, there is a big skepticism that I share personally. So I still remember this front page of The Economist where it says, financial markets always find new ways to burn money, right? So, okay. That's still true. I mean, of course, we can now find the appropriate macro-prudential regulation for the current situation. But as many of the speakers also have pointed out, what is it worth in a situation where financial systems are inherently unstable, inherently prone to be exploited by selfish agents? So that's the question. The question then is, what can we do about a regulation system that is not 1 year or 2 years or 3 years behind what's coming up right now? So maybe we can already anticipate Basel 4 and 5 now and not just wait for what happens in the next few years. So there's also the principal skepticism on my side about macro regulations. If you take a physics example, then you know that there are gazillions of micro approaches that are compatible with the same macro state, right? So that means from this inherent theoretical consideration, we already know that by just regulating the macro state, we are not really able to guarantee that the system works efficiently and secondly, the way we want it. So that means there is this tension between the agents that try to exploit the situation their way to make profit. The regulators that are not really independent, as you said, and still are in the position to suggest macro-prudential regulation, yeah? And the principal instability that has to be regulated in some sense. So please, yes, please, Mr. Dick.
Perhaps so was directly addressed more or less. I can respond first. I mean, this issue of you say don't trust central bankers or you trust central banks at the moment. I don't know about your side of the Atlantic, but I don't know if you read the press here. I think at least the ECB is one of the few European, at least institutions, which still has some credibility in handling the crisis. So that's just as a general remark. But more precisely, I mean, you mentioned this episode.
Wearing quite a few hats today.
Voluntary or not voluntary.
I'm also
PSI
one of Armin's first
CBS.
Students at
I mean, it's true. I think
Zurich, actually.
definitely
I
the
took a year
thinking
off,
within the
so
ECB evolved on this issue, and initially it was
possibility
indeed
to attend,
the thinking that
the first
if there would have been a
photogrammetry
trigger and
lectures with your
initial debt
predecessor, then I was a
involuntary
year away,
restructuring,
and
that we were afraid of the contagion
I already
effects
profited
that might
from
have.
the
At some
from
point,
the lecture
the
notes
thinking you
Lawrence Horney
were
presented
sketching out
before.
that insurance is there
Then,
to
as Manos
insure somebody,
mentioned,
right?
I was
So I think that
short-time
thinking
postdoc
evolved.
team member
But honestly, I mean,
before I,
to suggest that
moved
has
somewhere
been
else.
done on pressure
And,
of
I also was
particular
a
financial
former
market
colleague on
companies,
the
I think
board
that's a
of
bit absurd. So I think there
Swiss
you completely
Society
misunderstand the
Photogrammetry and Remote
independence
Sensing.
of the ECB
And,
and its decision-making
I'm
bodies.
currently
Also,
one
we
of
are
the
not
very
there to
few
protect banks,
fellow
right? We are there
professors in
to protect
photogrammetry
the
and
euro,
remote
if you want
sensing in
to.
Switzerland.
But that's not our goal
I
to
would
protect
say
banks.
it's
We're
an
not
almost
supervised.
endangered species these days. So maybe we should talk to Greenpeace to do something against it.
No, it's a
and
draft
make sure
regulation
they
since yesterday, which
don't,
was suggested by the
get
Commission, but it still has to be approved. And then just one thing, another thing also Professor Stiglitz mentioned on the, he said on the European design, it's not yet focused on the structural aspects, right? So they don't see kind of how we deal with the systemic risk, which is materializing kind of.
Some of the things have to do with the society, some are more personal.
Probably for
I will talk about photogrammetry versus navigation. I will also
what's going
talk
on. I mean,
about
if
not
you think
thinking much of
what are the
photogrammetry.
three really fundamental
And
flaws of
I will
design?
try to present Armin Grün on a single slide.
First one
I will talk about the B.
The fiscal policies, right? So
logo,
we realize that there's a deficit bias in democracies, which is always there, but it's particularly strong in monetary union because you can draw on a common pool of savings.
It was about
and you
86,
don't suffer
87.
negative
I
responses
was
of
a
interest rates,
student
for
delegate
example.
in
So we
the
needed
revision of the
fiscal
curriculum
institutions to counter this incentive. We had, this was realized,
Abteilung
right? We had
8,
a stability and growth pact, it was weak. It was not used, but it was weak.
I remember
But
some
if you
fierce
see what has been
discussions
going
with
on, now as
Armin.
an example, we have the
Armin
six-pack,
was
the
trying to
two-pack.
push
For example,
photogrammetry,
small things which I don't know that everybody's aware
I
of,
really
which
got
have major
hooked on
effect.
inertial
You
navigation
reverse
systems
this
on laser
qualified
gyros
majority
and
voting
things,
so that now
and
when
Kalman
sanctions are
filters, and I was
proposed,
trying to
they go
push
through unless
navigation
there's a
at that
qualified
time.
majority against
And,
it.
yeah, we had some
before
heated
it was the opposite.
discussions.
So they're small things, but
And
they're very crucial. And
20
finally,
years
we're
later,
developing
we
towards
have
with the fiscal
direct
debt
georeferencing
limited
established.
constitutions.
We have mobile laser scanning and everything.
Towards the movement
we have
to fiscal
systems
union.
such as
There's
those
a lot of things
producing
which is
very
at least
nice,
planned. So problems you realize.
almost near
Same
reality
thing, main
imagery,
second main issue,
almost
flaw.
fully automatically.
The theory of
And I'm
endogenous
happy to
optimal
say
currency areas
that
was a
we were
little
both right.
So we
We
all
should
hoped
have had
that
more photogrammetry
within monetary union
and more
institutions would
navigation
adjust,
at that time.
that productivity
So,
differences would
glad
kind
to
of
say we
be
both were
eliminated, and
right
there would be an adjustment mechanism.
During those discussions,
too slowly in the first
I
10
remember
years.
the statement by Armin
If you
quite
see
well.
What's done on natural structural measures,
He said,
reform
yes,
measures,
Mr.
not only on the
Nevitt, we
fiscal
know
side, but on the structural
that
side.
you do
it's
not think
enormous.
much of photogrammetry.
On countries that we might not have expected at this speed.
I'm very glad that Armin
if you see
proved wrong in that
recently
respect.
Now the compact
I know
for
I was a bit of a
jobs and
slow
growth.
starter. It took a while
relatively significant
to
amounts
get
from,
me
for example,
hooked
foster
on the
labor
subject.
mobility. So
But maybe if
also
we
that
think
issue
about
is
lessons
addressed.
learned,
We have to see how
never
far
give up on a
implementation
student.
then
He
goes.
might change his
Third thing,
mind
that
later
was
on.
one of my main
And
points,
for me,
the
never
lack
say
of
never,
common
because if
supervision
at that
a
stage
banking
somebody would
union.
have said, you might become a
For
professor
all the
of
reasons I
photogrammetry,
had mentioned
I would have
previously.
bet
Also,
a
this
lot
is
of money.
is
I
now
would have
addressed,
lost
right?
a
That
lot
we
of
need
money
this
at that
common.
stage. So,
We need to complement monetary union
think we
with,
both
with a banking union.
learned our
Not only the
lessons
single
there.
supervisory
So this is
mechanism,
the
which
attempt,
we
I said,
suggested yesterday,
presenting
but also
Armin on a
common
single
deposit
slide.
guarantee scheme and
I looked it up
resolution
briefly.
mechanisms. that's all planned now. That's realized, and you're surprised how far and how fast the progress there is. So in that sense, I would disagree that we address the issues. I think they're in the pipeline.
Rather more important subject. The reason why I created this word cloud on actually your
remark that you were skeptical that, for example, the ECB would not be in a position to set up this
Swiss society,
supervisory mechanism in a short time.
Switzerland and things. And I'm aware that we had so many other activities. You saw it.
When the thing goes through, it's finally decided.
Travel
we strongly rely on the expertise of the national
certainly very
central
impressive.
banks, which are in 12 of the 17
cases.
cases, they are supervisors already. 2 more other cases, they're heavily involved. So 14 out of 17 have the expertise. The expertise is there. It's just a question of, again, of this political pressure and this political biases, which somehow have to be dealt with.
Okay, thanks. Jean-Charles, Didier, and then Rama. Yeah?
Thank you very much. I want to comment on 2 points that were raised by Joe Stiglitz. One about price discovery and the other about the bad design of markets. I believe a good illustration of the combination of the two is the design of interbank markets. In the past, interbank markets were centralized, and basically the central bank was insuring banks against the default of their fellow banks. So the price discovery was extremely simple. Then there was the notion that the market should be decentralized to avoid more hazard and to avoid exposure of the central bank to the losses. So the idea was a kind of peer monitoring where each bank would lend to one another and be not insured against. So how can you imagine a price discovery in such a model where when you want to lend to a bank, you don't know what the bank has done with his money elsewhere? And so even with full transparency, which was not the case, even with full transparency, you cannot just discover the price. So you need to think of a better design than a completely decentralized interbank markets. The other thing I wanted to make, the other point I wanted to make is and it reinforces the same question of price discovery, is the legal uncertainty. And this was also related to Joe's remark about the Greek default. If some institution is there to change the rules of the game after the game I started, then how can you discover prices? How can you have So the notion here is really not to condemn capitalism, to condemn markets, but to condemn, a certain form of capitalism that is controlled by a minority of big companies. So this is the title of a book by 2 Chicago colleagues that, I don't necessarily, like their views, but the title is well found. It's Saving Capitalism from Capitalists. So we think we have to preserve markets from the influence of big players.
So, please, Didier.
Yes, I would like to come back to the point raised also by Jean-Charles before, and completely supporting and actually emphasizing this, that a lot of, if not almost everything, has to be understood from the, let's say, influence or control of lobbies. And I would like to actually make a point that this is not, of course, reduced just to the financial system, but just to take the example of the agro-industrial system and big pharma, basically the market view is to keep us all marginally ill, rational point. Of course, you want to have guys who earn money enough to buy all the high level production as well as the pharmaceutical output. So there is a fundamental market failure there, which is even of a bigger proportion to me in terms of the impact of mankind, the 30% of American OB, the extraordinary loss of welfare globally. And this is something that we have to consider also together in a systemic solution. And I would like also to point out that we speak a lot about regulations, but then we have to address the question of what psychologists have documented many times again and again, and this gets forgotten, which is the illusion of control. The illusion of control and the complexity problem, simplicity versus complexity problem. So illusion of control is the idea that we are hardwired in our brain, and I borrow here from a lot of evidence from a lot of behavioral and psychological and neuroeconomic studies. We are hardwired to build stories and to rationalize in a deterministic way the complexity of the world. This actually was something that was developed as a very efficient evolutionary calculation device when we were hunter-gatherers, but big misfires in the, I would say, in this complex modern world. So when we speak about regulation, there is a big issue, and Frank made a very good remark, that when you look at the measure of complexity of regulations, the size of the bars is well-known. The graphic shows the number of pages of different regulations from the Federal Reserve Act in 1913, Glass-Steagall Act, we can almost not see it, and that the big bar is the Dodd-Frank Act, just 2 years ago. So how, and when you see the Sarbanes-Oxley Act, it's not that big, but we know that it's actually an efficient way for companies to hide even better under the premise of transparency. So there is an idea that we can learn from complexity, but I would propose for the debate that actually we need to go back to simplicity. And then it raises the next question is, why do we need the banking system? And in particular, this structure that you were referring to of the $350 trillion as an example. Why do we need it? Do we really need the banks as what they are doing? Are they actually bringing welfare? And if we ask this question of really of course, banks are super important and super are intermediaries and so on. But the level of welfare that they are bringing is extremely questionable in my view. I don't see evidence. This is a research agenda, something that is extremely important to do, because if we are informed about what really is the added value of the size of the banking system, then it should be less difficult to restructure them. And, for example, have extremely strong restructuring, going back as an extreme to the Glass-Steagall Act, for example.
Mm-hmm. Okay. Rama?
Yes, so I would like to go back to the question of transparency and information that has been raised in some of the comments. One of the reasons I'm skeptical about the efficiency of macro-prudential regulation as is being implemented now is that if we compare the situation on transparency and the information available to regulators and market participants, we're pretty much in the same situation as in 2007, 2008. The question is, for example, do we have information now that would have revealed something like the AIG fiasco if it were going to happen again this year? And the answer is no, we still don't have that information. Let me give an example. There is, we talked about LIBOR, but an even bigger market is the interbank swap market. So it's a $450 trillion market, which is over the counter. It's not going through exchanges. And I participated in a study in 2010. There was a working group led by the New York Fed, the SEC, and some industry participants. And the question was, what is the state of market transparency in these OTC markets, and what can be done? So we were asked to do a study, interview all the market participants, the data providers, Bloomberg, ICAP, all the platforms where these things are traded. So I knew a little bit about swaps, but I didn't know the extent to which this market is opaque. I was very surprised to learn that there is absolutely no disclosure requirement on prices before or after trade, so neither offers, bid offers, nor post-transaction prices in the swap market. So this is a $450 trillion market. It's not some exotic derivative. There is no disclosure requirement. So what did we say? Well, we wrote the report. We said that this is the case. We asked the data providers, the inter-dealer trading platforms, which is fully electronic. They're fully electronic. We asked them, why don't you publish, some average of prices like an index? At least people will know where this thing is trading. They said, oh, the system is there. If they want us to publish it, if the regulator says publish this, we can do it in 48 hours. We have, everything is there, everything is wired. All these things are confirmed electronically. The dealers do not want us to do it. They say, if you publish, we will not send our transaction to your system. So, and this is a market which is controlled by 20 banks. It's a very oligopolistic situation. 20 banks do 80% of swap transactions in the world. So we, in our report, we said this, it's very simple, and we said that, our recommendation is at least publish a daily average of transaction prices so people will know where to actually mark their books. It's not even, something esoteric. How do you mark your books? And this seemed like a reasonable proposal. We didn't propose to scrap the market, just to publish daily indices. And it went to a vote. The SEC was to vote on this, and I didn't participate in the session because this is something behind closed doors. But I was told that the proposal lost by one vote. So there's something like, 10 or 12 commissioners there. It's not a big group. It lost by one vote. And we never heard the justification of why this was an unreasonable proposal, because the asset managers were for this. Big asset managers like BlackRock, PIMCO, they're not really, anti-capitalism people. They were for this because they said, we're buying these things, a group of banks fixed the price, we have no idea what's going on. And this was refused, it was turned down, no explanation. And then 2 months later, this is in December 2010, one of the members of this commission, one of the commissioners, the SEC commissioners, left his job and joined a certain investment bank, starting with G, as chief regulatory officer. I mean, this is an example. I didn't dream this. This is an example which I saw personally. It's not a rumor. And so, you dismiss some allegations as absurd. I don't know about that specific case, but this is a case where I saw something very reasonable being proposed. Many market participants were for it, but it was refused. So this is a market which there is no transparency still after 5 years after Lehman. So I mean, I'm not very optimistic about the rest. This is one of the largest OTC markets. So,
okay.
So this is my.
So here, Bloom, please. Yeah.
So maybe they have to pay more to central bankers, so they are more independent and don't have an incentive to switch to industry. But I would like to follow up on this idea of control illusion. I think we shouldn't have false hopes in regulation, in achieving some fine-tuning, micromanagement of institutions, of banks, for instance. I think that we have now seen where this leads. I think it was one major contributor to the crisis. I think what we can realistically try to achieve is kind of correct the worst bad incentives and try to better align incentives of market participants, of banks with social interests. And one way of achieving this would kind of be very simple, just strengthen the shock absorbers in the system. For instance, increase capital at banks. This would address many of the problems that have been kind of mentioned in this round here. And here the political economy problem of Jean-Charles Rocher comes into play. The problem is that industry is a much better seller of ideas than academics. So for instance, industry has managed to sell the preposterous idea that capital is excessively costly. And people, politicians, they believe or are willing to believe the industry. Here academics have not succeeded to really show and argue to politicians, to the general public, that actually capital is not costly. And this leads to this very strange capital requirements where we require banks to have 2% of capital in relation to their total balance sheet. I mean, if you look at normal firms, I mean, if you would go to a bank and try to get a credit, a loan or a mortgage, and you only have 2% of equity, they would kick you out of the building. But for banks, this is a normal way of business, just to have 2% of capital. And this is based on this selling this idea that that capital, at least for bank, is excessively costly. And here probably it could be something for academics to also engage more in this political economy side of things, and also focus research on the actual implication in the real world, taking into account these political economy mechanisms.
Mm-hmm. Okay. I have a number of important points on my agenda still, and I also realize that Peter Fischer and Joe Stiglitz didn't get the chance to involve themselves in this round, but I still would like to take the opportunity to open the discussion a bit towards the audience here. My suggestion is that we take 3 questions or statements from your side, and then I ask the panel to give a few comments. Please. Yeah.
Well, I would like to comment on the data gathering issue, and which is also related to this idea that central bankers, well, I am a central banker, so the point touched me very, very into the essence of my work, I have to say. When I work for the FSB working group on gathering data for detecting systemic important institutions, and that was a hard work. That was a hard work not because the banks didn't want to share the data, but some of the regulators had the idea that this was too intrusive, was unnecessary. And they had the idea also that, I'm not going to say about any regulator, but some regulators were willing to get the data from the banks because they said, oh, we are going into old-fashioned sort of banking management. And I said, in Mexico, we had a big crisis in '94. And after that, we started to ask a lot of data from the banks. And we do follow very closely how they are exposed to each other. Our models are heavily based on data. So I'm wondering how they can go to sleep without really knowing how the banks are exposed to each other. If the banks don't know to which specific counterparties they are exposed, they are doing their business very badly. And we had a meeting also with the private industry, one guy from the UBS, and he made a joke in order to let you know how they feel about us as regulators. They say, well, we work for central bankers. He was a chief risk officer at UBS. We work for central bankers, but we are paid by our banks. So that's the idea. So we are sort of in the middle. We have a hard job trying to get the data. We have a hard job also with the banks, and we have also a bad time with the academics. So okay. I agree with you.
Thank you very much.
We should be better paid.
Okay, second statement here. Fernando, and then Imre. Yeah? So short statement, please, if possible.
It was mentioned the dynamic instability. I think Leo Stiglitz mentioned it, stressing that some rules can really lead to unforeseen instability. But I was thinking in relation to this, the role of expectations as being a source of instability, having this feature of self-fulfilling that really leaves no anchor to what possible outcomes a priori the market can have, and therefore gives an enormous role to whoever plays the position of a leader in expectation formation. Okay, and that often will be something that regulators are very in bad position to address, and therefore limit the instability of the market associated to it.
Okay. Last statement. Can we get the microphone, please?
Even without knowing any details about the banking system or capitalism or whatever, it is absolutely clear that the system is full of positive feedback on each level. Now, such a system cannot be stable. This is a big, huge structural instability. So that I am very much on the same plane as Didier, that this system is hopeless to regulate if we wish to uphold the hope that it's still going on, growing 2, 3, I don't know how many % a year. So the present state of affairs is a big bubble. Right? The whole thing, what we are trying to get back, like on this graph of Didier's, what we are trying to get back is still a bubble. Evidently, this is structurally unstable.
Okay, thanks. Now let's continue with Peter Fischer.
And I don't know if I'm the right to answer this question, but maybe first on the question of, are we in a totally different world? Is there a fundamental regime shift? I don't think so. I think always when we diagnose a fundamental new world, actually we are in the middle of a bubble that is bringing us back to the old one. Second, of course, I think financial intermediation is important if it is real financial intermediation, as well as I believe capitalists are important. Without capitalism doesn't work. However, it's also natural that they seek profits and try to lobby for their interests. So then we are back to the very basics, that you need competition and you need a system Ordnungspolitik that works. You need transparency. And one final point. If I look at those representatives, I think I do trust central bankers sometimes. And one reason is that I think they are, in central banking, you typically have technocrats with a clear target, namely price stability. Now, for me, there are two problems. One problem is when the targets become too manifold, then you don't really know anymore how they act. And the second issue, I'm also concerned about the ultra non-conservative monetary policy. But then, if I start to question what is going on in central banking, then it's more because obviously there is more politicization of central banking and much more political pressure, if Joe mentioned the Greek example, than has been. So I don't trust, finally, I don't trust governments and the way they work. And I think the problem is that they gain too much influence on monetary policy. And then we are back to Charles, the political economist.
Okay. Joe, please. Yeah. No, he has his own.
Well, I've been trying to decide whether I'm optimistic or pessimistic. I think, on the one hand, I think this experience of the last crisis has brought to the fore, even if we haven't learned something, it was only reminding us, it was reminding us of things that had been forgotten, and that can be useful. On the other hand, I'm struck by a number of things. One of them is one of the most important ideas in theory of finance that we teach all our students is the Modigliani-Miller theorem. And I have not found a single banker that understands it. You know, there are little debates. I've got myself written criticisms of why it may or may not be exactly applicable in a certain situation, but the basic message of the Modigliani-Miller theorem is that the cost of equity is not really higher than the cost of debt, that you're just shifting risk, is true. And I haven't found a single banker who understands that. And that's deeply disturbing. If the bankers are supposedly managing our risk, that's a worry. I also haven't found that many central bankers that have understood it, but I'm sure there are some in Frankfurt. That also is a concern. The second reason I'm a little bit pessimistic is back in, I was involved in the 97 financial crisis. It was often emerging markets in East Asia, so it was nobody paid. It wasn't real people that were dying. That were losing their job, 40% unemployment in Java. Those aren't real people. So we didn't pay too much attention. But we were doing regressions and doing things similar to what is going on. And in fact, this Financial Stability Forum was created to ensure that we learn the lessons of the East Asia crisis. And I think what happened, the people who actually had misbehaved before were the people who were appointed in charge of the Financial Stability Board. And guess what? There wasn't much change in financial regulation. A little bit, but not enough. And I think what we saw is the financial markets got worse, not better. So that makes me a little bit less than confident that we will have solved the problem. We did actually a lot of econometrics at the time of what causes vulnerability. You know, what are the things that make it most likely? What I saw very clearly was the role of politics in the rhetoric of blame. So you listen to the central bankers, Rubin, Greenspan, all those people, they say, oh, it's lack of transparency. If you looked at the regressions, transparency was not the major factor that would explain the crisis. Partly, the last set of crises was in Scandinavia, the most transparent country. So clearly, as a single explanatory variable, that wasn't going to do. If you looked at the other things they said, you couldn't, the political rhetoric was totally out of line with what the statistics show. And the interesting thing is what the statistics show didn't lead to better policy over the next decade. So I'm not totally confident. There was a major reform done by the G20 in changing the name of Financial Stability Forum to the Financial Stability Board. But I'm not sure that that change in the name is enough to secure stability to the economy. There were a few other little institutional details that went on, but the name was the most important change, and I'm not sure that that is enough to ensure stability. So, I think all of us here think the financial sector is extraordinarily important, and if the financial sector is doing its job, it really is necessary for the well-functioning of the economy. Okay. But I think the point that's been raised here in talking about the multi-trillion, $100 trillion markets in derivatives and based on LIBOR or based on interbank lending and all that really raises a question, what are these doing? I think that's a really good research. What is really going on? The point that Paul Volcker made, I think, has not yet been refuted by anybody in the financial system, and that was he has not seen a single innovation from the financial sector in terms of structured products that had led to any improvement in the real economy and well-being other than the ATM machine. And he made one mistake because he tried to get credit for America for the ATM machine. It was a British innovation. So in fact, if we're describing America, there's not a single one that he could find. And we can understand that because the incentives are misaligned. But I think that there's a real research question here on what kinds of innovations, financial innovations, will make a difference. The agenda, Derek Turner has pointed out, I think very forcefully, the agenda of the financial markets as they've articulated, completing markets, which was based on a misunderstanding of the theory of the second best and error-to securities, has been misappropriated and actually led to more unstable markets. I think that is an important research agenda, that in the ways in which the agenda of completing the markets is actually may have contributed to instability. Finally, I do think that for the most part, I'm not as much against central banks as I may have seemed. I think I can't imagine a world without central banks. So, you know, we have a politician in the United States called Ron Paul, who is trying to abolish the Federal Reserve. And most Americans agree with him, by the way, which says, I think, both about most Americans and about the Federal Reserve, both. That the Federal Reserve has united America against itself on the left and the right. But I disagree with them. I think central banks are important. They're very interesting because their very existence is an intervention in the market. One of the most important prices is set by a government agency. And yet, the irony is that central bank philosophy in many countries is a belief in markets. So you will have an institution which is setting a key price and says, I believe in free and unfettered markets. So you have to say, what's going on in their mind? They realize that something isn't working, and then they have a theory that if we just fix this one price, there's no general theorem that supports that view. Okay. It may be a practical matter, but there's no general theorem supporting that view. But I do think that most central bankers that I've met, I think all the central bankers that I've met, believe that they're acting in the public interest. Okay. So I don't want to suggest that at any moment they thought that they were shills for somebody else. But this is a very important thing of behavioral economics or cognitive capture that I talk a lot about in my new book, The Price of Inequality. When the Federal Reserve and the Treasury, and I won't name names because it's irrelevant, when they saved AIG, $150 billion went to AIG. Everybody wondered, where was that money going? You know, $150 billion is a lot of money. I know a lot of you deal in the trillions. We'll be talking about $150 billion. For poor America and going down is a lot of money. So where did it go? Because at the end of the day, it wasn't in AIG. And Bernanke refused to tell us. Now, the good thing, America has a Freedom of Information Act, and Bloomberg went to the courts to say, you are a public institution, you have to tell us. And what did the Federal Reserve do? It fought, it lost. And what happened after it lost? It said, we don't have to tell you, we're above the law. And they appealed to the next level of the court, and the next level of court ruled and said, you are public, you have to tell. And the Federal Reserve Board said, and Bernanke said, no, we're not going to tell you. Okay. We're going to appeal to the Supreme Court. Okay. Finally, the administration said, you know, guys, you are part of the government. Mm-hmm. And if the courts have said you have to tell, you have to tell. Now, by now, we all knew the answer. I mean, this was all a charade because we all knew where the money went. The number one recipient, and I don't want to blame them particularly, the number one recipient was Goldman Sachs. And it was an embarrassment, obviously, that was where the money was going. It went from AIG to Goldman Sachs. And then the next two recipients, largest recipients, were French banks. The question was, if the French banks were in trouble, why didn't France save them? Answer is, one suspicion is the money went back from the French banks back to America. So that's where the interlinking goes. We don't know exactly because we don't have full transparency, and they work very hard, going back to your point, not to have that transparency. Final general point. So the general point I want to make is, while they believe, I really truly believe that they're doing what they believe is in the best interest. They thought transparency would disturb the market. Disturbing the market would not be good. The way they see the world is through a particular set of eyes that I think at least one can raise questions about. And the final thing I want to make is I think the ECB, the Eurozone, are working to try to address a lot of the problems that I mentioned. I mean, I think there is this process of learning. But what I was commenting on was the nature of the instability of systems. And that they created 12 years ago a system that was dynamically unstable and should have been seen 12 years ago to be dynamically unstable. And that when they were creating it, there should have been that kind of discussion. Is the system stable? Because if it's not, even if we have a small perturbation, it could be thrown off kilter. And this is what I was trying to respond in a way that it's not just the big black swan events that can cause problems. If you create a dynamically unstable system, even smaller events can have big consequences.
Okay. Thank you very much, all of you. I'm afraid I cannot open up another round of discussion because of time. Let me just draw your attention to two problems that I picked up from the different statements. The first problem is a theoretical one. Some of you have expressed the need to sketch new economic models that represent the financial sector in a more adequate way. And some of you also have pointed out that it needs data, the disclosure of data that we do not have currently about how the financial sector really works. This is one big issue. It's a theoretical challenge to come up with new model, but it's also a data issue to calibrate and to understand how these models work. The second interesting point I picked up was that almost every one of you has mentioned the importance of political economy, right? I was expecting whatever discussion about new indices or these kind of things. So no, that's a very fundamental and basic thing. It has to do, I would say, more with other dimensions of our society, though, because political economy is related also to deep social issues like how do we trust each other? I do not trust the government. I do not trust the central banks. These were statements that you made, and they inherently link back to political economy. What's the system, the democratic system we are in, if you can make these kind of statements here? So that's a very important thing that also relates to the issue of moral hazard that some of you have brought up here. So we should not underestimate this domain of political economy, although in our education. So that's a lesson I learned here from this panel discussion. With this, I think we should thank all the panelists for their contributions here.